Hello and welcome to Market Domination. I'm Julie Hyman. Josh Lipton is off today. We're an hour away from the closing bell on Wall Street, and I want to take a look at the major averages here because we are seeing stocks come back at the moment here, all three major averages. And if you take a look at the Wi-Fi Interactive, you can see the intraday movement higher because earlier things were kind of bumping along, not seeing much change. And then, I'll call it just about an hour and a half ago, we started to see gains really take a leg up here. The Dow right now up almost 480 points, 1.25%. The S&P 500 up by about 1%, and the Nasdaq Composite up about 0.8%. It was of the three major averages, this was the one that was really perhaps at risk of falling during the session. You know, what we're seeing here is in part due to what's been going on with large cap technology. We're going to dig into this more in a moment. But earlier today, all of the Mag 7 were down. Now we are seeing more of a sort of split trade within those large cap technology names. And I do want to say also, Josh isn't with me today, but we do have a special guest. BD8 Capital Partners CEO Barbara Doran is with me, and she will be with me for the next hour as well. Well, digging into some of the other things that we are watching now, Barbara, as I just mentioned, the Magnificent Seven, we were seeing them earlier today lower. That was sort of hampering the ability of the NASDAQ to rise. Now we're seeing more of a mixed picture here. But overall, we're seeing stocks that are now recovering. Doesn't feel like we're out of the woods, though.
I don't think so. I think there's a couple things. One, there's been too much damage done in such a quick time. And the reason for the damage, the reasons have not gone away. And that's been primarily tariff uncertainty. And you've seen that show up in the numbers, whether it was February retail sales, which were lower than expected, worse than January, February. Although, interestingly enough, and this is where I think it gives an indication that the consumer is holding back, is that personal income was up twice what was expected, but spending was down half of what was expected. So I think you're seeing this. You're hearing from company managements that it's hard to make plans. It's hard to make hiring plans when you're not sure what the tariffs will be, who it's going to impact. And so it's shoot first. Everybody runs for the hills. And so you've seen all stocks go down, but of course, profit taking in the biggest names.
Yeah.
We came into this market 22 times. The S&P forward earnings, it's now 20. And of course, the Magnificent Seven, ex-Tesla, I think Tesla is a special case right now. In fact, always has been. But you've seen in general, the average PE there has come down from 35 to somewhere in the mid-20s. And NVIDIA down to its trough PE, you know? And so that's been just about to begin a major product cycle.
Yes.
Yeah, their biggest ever. So I think that's really been a question of primarily profit taking, because these are the names you turn to when you want consistent, visible, strong earnings growth.
Well, and it's interesting. So let's dive into the semiconductors for a minute. And I have them up on the Wi-Fi Interactive as well. NVIDIA down 0.9%, which is pretty remarkable considering it is kicking off its big GTC annual conference this week. That's usually where it talks about new products, right? And gets the excitement going for the stock. NVIDIA is actually the only one of these semiconductors on our board that's in the red right now, which is pretty incredible. You got a name like Intel, for example. Lip Bhutan is going to be taking over as CEO tomorrow of Intel. There's some reporting today that he's going to be changing strategy, maybe doing some job cuts. So I guess the other question I would ask, as we look at semiconductors, as we look at large cap tech, as we look at the valuations that have come down, have you seen that as an opportunity to step into some of these stocks?
Well, I have actually, even though a lot of people are saying, look, we've got April 2nd, this is going to be all the reciprocal tariffs, we should wait till then. But the fact is, in this last few weeks, you have had such opportunities. And very often you do in these kind of massive sell-offs where everything's being thrown out. And so you've got NVIDIA was down, to what, 105. I mean, that's crazy. I mean, it got down to 22 PE. So names like that, you say, even though we're not sure this is the bottom in here, because there's going to continue to be so much volatility until the tariffs wind down. Although, I'll tell you, I think we're getting to the point where it's almost like the boy who cried wolf. It's like, okay, here we go again. And I think it'll be interesting the next time that President Trump comes out with, a major tariff change that we weren't expecting, what the market does. It just might not do a lot.
Interesting.
Yeah, I think
maybe
we're
getting numb to it.
Maybe.
After a while. All right, well, let's talk, sort of take a step back, take a look at the market sentiment, which has been shifting downward, the moves today notwithstanding. And some investor expectations for the S&P 500 are starting to follow that sentiment. Markets reporter Josh Schafer is here with a closer look. So we got another forecast cut today, this time from RBC.
Yeah, so this is our third S&P 500 year-end target cut that we've seen over the last week. This one from RBC Capital Markets, Lori Calafacina. She now sees S&P 500 at 6,200 at the end of the year, down from 6,600. Of course, couple ways to cut that. 6,200 is a pretty decent rally from where we actually are now, right? But what I think Lori highlighted within that note has been the trend, which is our economics team now sees lower GDP than we initially thought. When we plug that GDP growth into our model, so 1.6% GDP instead of 2% GDP, it moves the numbers around a little bit, right? And we're not going to get to that same level of the index. What I thought was interesting also within the note, though, you guys were just discussing the potential for a bottom, right? And how do we sort of call bottom here? Obviously, calling bottom itself, literally, very difficult, right? Yeah. Most people don't recommend that. But the concept that Lori was highlighting was we've seen sort of the vibe shift in consumer sentiment in the soft survey data. We haven't confirmed that with hard data yet, so it's hard to judge basically where the market's headed until we get more hard data. Not necessarily what even is the hard data going to say, but just we need to get more hard data, more jobs reports, more earnings guidance, more information on how corporates are actually digesting this at this point.
Well, and it's sort of the other thing that we've all been discussing is the so-called uncertainty in the market right now, right? Which tariffs are going to stick? Goes along with the hard data. Mm-hmm. What's it actually going to confirm? Even if it's bad, at least we'll know, right. I guess, is the idea behind all of that.
Barbara, I'm curious, when you look for sort of the bottoming out of the market, or what sort of indicators you're watching right now to feel like we've gotten to a point where you want to get back in, what things do you look at?
Well, a number of things. Yeah. One, on a stock-by-stock basis. You know, when you've seen the names that we mentioned, NVIDIA earlier, or any of the big stuff, when you look at the charts and where the PEs are, and their earnings are still good. You know, even, I don't see a recession. I mean, this economy is starting from such a strong point. You know, even if you put in worst case, the stocks are oversold. So, and then you also look at something, Friday was interesting because we had the University of Michigan sentiment numbers, which weren't great. The last two sentiment numbers for consumers a couple of weeks ago were not great either. They showed a big jump in short-term inflation expectations. The University of Michigan Friday was also long-term, and that's more worrisome, because if that gets in, you have this self-perpetuating cycle. And yet, with those bad numbers, the market went up. So I think that's a very, that kind of thing is what you look for. And today I wouldn't have been surprised if the market went either way. I'd have been surprised if it had a big down day, but I thought it's finding a base in here. It's feeling its way. And so it's an iterative process, at this point. And it was very interesting. Tom Lee's work. Mm-hmm. He looked at, this has been one of the fastest corrections, that we've had. Mm-hmm. And down 10%. S&P was down 10% last week. But Tom looked at the last 6 before this that were were super fast. So he looked at the 7 last super fast corrections. And with that exception, and we'll see if this is the one exception, the market was higher 3, 6, and 9 months later. So, I think we've had just a big overreaction and people assuming, oh my God, the sky is falling.
The rally off the bad news is an interesting point to me too, right? If we continue to see that off some of these prints, a lot of people will argue that means that the bad news is, of course, priced in at that point, right? And so when you have that quick, swift correction that happens in less than a month, maybe we got a little aggressive here. Julie, we were talking last week about some strategists arguing we might have already priced in a shallow recession. But no one's actually really calling for a shallow recession, right? So from that argument, you could say, maybe we just went a little bit too far here, and sort of where do we actually land on the course of economic growth this year? What is the actual projection this year? Sure, it's slower than before, but is it really that bad? And I don't really know if we have a solid answer to that question.
I mean, if you take the other side of that, I would say, what's going to be the thing that takes us out of it? In other words, yes, maybe the market rallied Friday despite bad news, but what then is going to be the positive catalyst? What would give people a reason to buy sustainably? Is it just the absence of bad news, or is it actual good news?
Yeah, well, that's a good question. I think one, it will be the absence of bad news. If we stop hearing, that we're raising, the tariffs on champagne 200%. If that slows down, which it will at some point, and I don't think in the not so distant future, but I also think we're going to continue to hang on all the data, jobless claims every Thursday, because the Doge layoffs, they had targeted about 200,000 in layoffs, which in the grand scheme of things, is a teeny tiny portion of the U.S. and it'll be concentrated mostly in the D.C., Virginia area. But it's really, a question of what happens next in terms of, employment. and all the tertiary and secondary effects of that. But it looks like we're going to be able to absorb it, because there's still jobs out there. We're kind of at a 1-for-1 ratio. The JOLTS number was better than expected last time in terms of job openings. But I think right now we're kind of, the Fed has told us, and the numbers support it, that we're kind of in balance, in terms of jobs and openings. And so we'll keep looking. The unemployment number is good, 4.1%. And it could take a while for that to show up, if it's going to show up.
Right. All right. Well, Josh, thanks very much. You'll keep monitoring those forecast cuts, see how they shake out. Well, for more on the market action right now, let's get to PNC Asset Management Group CIO Amanda Agati. Amanda, it's great to see you. You've been hearing what we've been talking about here, this rockiness we've been seeing in the market. I know that you've been watching the volatility very closely. And even though, as Josh said, it's tough to call a bottom, I think we can have a discussion around what is going to help the volatility abate to some extent. What are you going to be watching for signals that things are maybe quieting down a little bit?
Well, it's great to be with both of you. Thanks so much for having me. There's a lot of variables that we should be focused on. I think the biggest one is getting to some stability or at least some clarity around fiscal policy. It's been the number one driver of market volatility so far this year, and there's been an awful lot of noise. It's hard to discern the noise from the news because it seems like it's one extreme or the other, and we aren't really sure what's going to stick. So from a policy perspective, getting some clarity will certainly serve, I think, to kind of solidify a bottom in the market and frankly, even catalyze a pretty significant snapback if it happens soon. But I think the other thing that's important is Q1 earnings season is just about a month away. I can't believe the first quarter is effectively over. And so I think from a revision perspective, it's been pretty negative and pretty scary. It's really catalyzed this growth scare narrative that sort of gripped markets. And so to see the rubber meet the road in terms of the earnings growth path forward and the fundamentals actually come in better than expected, I think is a really important catalyst for this market rally.
Yeah, Amanda, this is Barb. I think we're all expecting the Fed not to do much tomorrow. But what do you think the focus will be for the Fed? Will they be focusing more on inflation, given recent surveys showing long-term expectations for inflation are kicking up, or do you think they're going to be more worried about growth slowdown?
It's a great question. We think technical term, it's going to be a snoozer this week, which is a good thing. I think we need a little bit of calm and stability. As much as I might fight the Fed or debate the Fed on any given day about what they're doing or not doing, sitting on pause here and being a little bit more dovish in terms of its narrative, I think is the right path forward. They are absolutely right to be focused on inflation. We haven't won the inflationary battle. There's still some fire in the inflationary backdrop. But as you sort of zoom out from that and look at the landscape, I think we come back to this policy uncertainty. How much is tariff policy or trade policy really going to stick in terms of implementation? If it's narrow and targeted, we can work through this. But if it ends up being much wider in terms of scope, it's anti-growth, it's inherently inflationary, and so the Fed has a right to be worried.
I don't know. I think the horse is a little bit out of the barn with it being narrow in scope at this point, Amanda. But as we know, things can change on a dime, and they do. I want to get back to maybe the next thing that could help the market, and that is the fiscal policy you referred to, because I've been hearing an increasing amount of sort of debate and wondering on that, if there is going to be anything more than just the extension of the 2017 tax cuts. And whether, if indeed that is what it is, if that is enough, if that is what the market wants.
I think it's a great question. It's the thing that I wish that we were talking about more than tariffs or trade related policy, is it absolutely hits home instantly, right? In terms of what they do with the Tax Cuts and Jobs Act. I think unfortunately we've moved way past that, and there's an assumption that it's just going to continue at the level that it's been at, but it's not going to sunset, which is good news, right? In the back half of last year, we were a little worried about which direction this was going to take, but I don't think this is the thing that's necessarily a catalyst. I think it's just steady as she goes. Okay, let's move on and focus on tariffs, inflation, budget, debt ceiling, et cetera, et cetera.
And so, okay, so we've got the backdrop, which is still a little rocky here. What are you thinking? What's your latest thinking in terms of strategy then? Are you getting more defensive?
Oh, no, we're definitely not getting defensive. I mean, this is an environment where we think this is much more about a crisis of confidence, a sentiment hit, a growth scare, than really sort of a material impact to the underlying fundamentals. We came into this year solid from both an economic and an earnings growth backdrop. And so, there's been a lot of noise, a lot of uncertainty, but we haven't done permanent damage yet. So to the extent that we can get a faster resolution or maybe some additional clarity here in short order, I think the path forward can be very positive. And so we're using this correction as an opportunity to reposition portfolios. We're leaning into quality in particular. Some of the Mag 7 names aren't necessarily cheap, but they are certainly cheaper than they have been. And so picking up some of these really attractive long-term secular growers at these valuation levels is, I think, the right approach here. So stay invested, stay well diversified, put some of that capital that may be on the sidelines to work, use this correction as an opportunity.
Sounds good, Amanda, because that was going to be my question. It sounds like you're putting cash to work as we speak.
Yeah, I mean,
that's exactly right. Yes, absolutely.
And it seems like you two are actually somewhat in agreement on this point as well, that even though maybe growth forecasts are sort of ratcheting back, they are not going down. I guess to ask it another way, Amanda, has the decline that we have seen priced in an already slowing environment to the point where it's been overdone?
Well, I don't know that I would say that it's been overdone, right? Because we still don't know where the end state for some of this policy is likely to land. But I think we certainly have captured the lion's share of it at this point. So, is this effectively the bottom or not? I don't think that's necessarily the case. I think there's going to be a little bit more noise. But I do think that, we came into this year so strong that there is a little bit of headroom and a shock absorber from a growth perspective. What we didn't have was a shock absorber from a valuation perspective. We came in, with a market that's priced to near perfection. The backdrop clearly has not been that. And so that's why I think this correction has been maybe swifter and a bit more painful than what investors would have otherwise expected. But again, the fundamentals are still hanging in there. So we feel good about positioning in this environment.
Amanda, great to see you. Thank you so much.
Thank you.
We're just getting started here on Market Domination. Coming up, Tesla is getting another price target cut and the stock is sliding. What the analyst says is behind that lower outlook is ahead. Plus, we're tracking the top trending tickers on Yahoo Finance and key names to watch, including Chinese tech names Baidu and Alibaba. We'll have a look at what's driving that action coming up on Market Domination. Let's get to some calls of the day. We start with Tesla, which is also a trending ticker for us, getting another price target cut. This one coming from Mizuho. The firm lowering its target to 430 from 515. Of course, there have been a lot of price target cuts for Tesla as of late. By the way, the analysts there still an outperform on the name. So they are still positive on it, even as they are lowering it. And this is a note, comes in a note that's really about autos more broadly, but among other things, one of the things we've been trying to puzzle out with the tariffs is for the USMCA exemptions, which are those products that are exempted? Well, the team over at Mizuho said potentially 8% of autos and 20% of auto parts from Mexico are uncompliant and could see those tariffs. So that gives an idea of what could be affected. But they're also talking about some of the other things that are affecting EV sales, both in the U.S. and in China over the longer term. Barb Doran is still with us. And Barb, when it comes to Tesla, as you mentioned earlier, one of these things is not like the other when it comes to the Magnificent Seven. Tesla has long been sort of the outlier, both in what its business is and how it has performed. And lately, it has underperformed by quite a bit. What are your thoughts on that?
Well, I've never been a fan of Tesla as an auto company because I think it's always been overvalued. And then the stock has had a monster run in the last 4, 5, 6 months, and that's primarily because it's been repositioned as an AI robotics company.
Right.
But if you look at the underlying business, which is most of their business right now, the car business, it's under competitive threat. You've seen this around the world. It's not just them anymore. When they started, they were it. They invented this industry. And now you've got competition from abroad. You've got competition here. They have not come out with a new model in quite some time. They don't have a low price model. And of course, now we have a lot of pushback because of some of the utterances, the political utterances of the owner, Elon Musk. So, and I think you're hearing these stories around the country, that there's dealerships are being set on fire. They're setting on fire cars, particularly the trucks, the cyber trucks.
Right.
And so the brand is really taking a beating. And, we'll see. That's going to obviously hurt deliveries. It's going to hurt sales. And that's happening also in Europe. So we've got to see what happens. But I think there's not going to be a lot of positive news for Tesla, anytime soon.
And this is an interesting one because we were talking about valuation of the other Magnificent Seven. Tesla's hasn't come down, even though the price has come down. And so I was going to ask you, is this a one where it would get to a valuation where you would say, okay, maybe this is attractive, but the valuation, the PE hasn't really come down substantially.
No, it has not. I mean, when the stock had gotten down to like 120, it was still a 30 PE on the auto sales, where you've got GM and Ford at what, 5, 6?
Yeah.
That's crazy. So I think the stock would have to come down a lot more for it to be interesting to me. So they do have other parts of their business that are thriving, but I don't think that the PE here is justified.
Gotcha. All right, well, let's talk about another call that's a broader one. Goldman Sachs out with a new note on M&A activity. The firm reducing its forecast from 25% growth in deals to 7% amid policy uncertainty here. So basically, this would be U.S. M&A volume growth. They're saying it's now only going to be 7% this year from last year. And they say this is a function of U.S. economic growth, CEO confidence, financial conditions. They talk about tariffs, obviously, having an effect. And they say that this year, announced M&A activity is up 15% year over year. And Barb, what stood out to me from this note is not that M&A activity, IPO activity has collapsed. It's just that it's sort of trending near average, and there had been big hopes that there would be a resurgence this year, that this administration would foster an environment that would be healthier to capital markets. It doesn't seem to be happening.
No, it doesn't. And the M&A up 15% year to date, I think those were deals already in the works.
Yes.
And that's really hitting a 15-year average. IPOs are pretty much flat with last year. And that's why you had the big banks running. It was on the outlook for better economy, deregulation, and of course M&A picking up in their capital markets. That was Goldman Sachs, Morgan Stanley, JP Morgan. And it's not happening because, and I think the number one reason right now is the tariff uncertainty. Everybody's holding back. CEOs are not confident enough. And certainly for an IPO, you want to come into this market, you price it in the morning, and the stock, the market goes down 500 points and your IPO is cut in half. There's no way you're going to do that. So we'd had 2 years of 24+% returns in the S&P. Things seem stable. The economic outlook looks stable. And so that was all the predictions for M&A and IPO pickup were based on that. And now, we've seen, you would expect some volatility coming into the year because of the high valuations, but still fundamentals look good. Now, all bets are off. So it's going to take a while now, I think, for things to become stable and company managements to feel confident enough to come back.
I want to ask you about the implications for banks in particular, because obviously that's a source of their business when they have more deals being done, when there's more IPOs. At the same time that there's this concern about a slowing consumer. I'm just glancing on the Wi-Fi Interactive again at the big banks year to date, and we're seeing a decent amount of red here. JP Morgan is down, Bank of America is down, Morgan Stanley. Wells Fargo's up a little bit, but many of the big banks are not doing well. Is this an area you want to stay away from in part because of this lack of capital markets activity?
Well, no, that wouldn't be the only thing. I think I think they are depressed as the reason the market is down in general, because of the uncertainty about economic growth. There is a growth scare that's going on. And I think for those banks, obviously economic growth is important for banks. And so you want to see a pickup. Right now, probably lending will get more data, but lending's probably on hold. Small business, you've seen what's happened to the Russell 2000. When you've got everything on hold, people stop doing business. They stop borrowing, and that hurts the bank's bottom line. So I think that's why at some point they're going to be very attractive, because this will stabilize. So I don't know when, hopefully by the end of the first half.
Right.
But I think that's the problem. Yeah.
All right, let's talk economic data and sentiment. As we've been talking about, investors awaiting the Fed's latest interest rate decision at this week's Federal Reserve policy meeting. The meeting coming as inflation and economic worries are growing. Yahoo Finance's Alexander Canal joins us now with more and our stagflation watch, I guess.
Yeah, stagflation watch. And right now we're seeing this 2-day rally in stocks, but it's really that FOMC meeting on Wednesday that could potentially derail this comeback. And as we look ahead, it's really not about the actual decision, because we know with almost 100% certainty that the Fed is going to hold rates steady. Jerome Powell has indicated that. Markets are pricing that in. So it's really going to be that post-decision press conference, along with the summary of economic projections. That's going to be the thing that captures investor attention. So think projections like the dot plot that maps out where interest rates could be heading, along with other indicators like GDP, inflation, as well as the unemployment rate. And this will be important because markets have really been spooked that we're entering this period of stagflation. That's where growth stalls and inflation remains sticky. We've seen several Wall Street firms reducing their respective growth targets for 2025 as a result. That's been followed by a handful of downward revisions for year-end S&P 500 targets. So analysts are saying here that Jerome Powell is going to have to really thread this stagflation needle. He's spoken before about how the hard data remains solid, while it's really that soft survey data like consumer sentiment, consumer confidence, ISM manufacturing, that hasn't really been a good indicator when it comes to future consumption. At least that's according to Powell, but that really is the data that surprised to the downside recently and has pointed to these heightened inflation risks. So he's going to have to reiterate that stance. He's also going to have to indicate that inflation remains on the path to 2%. Even amid some of these near-term hurdles, we did see a deceleration in price growth for both consumer and producer prices during the month of February. But underneath the hood, the components that feed through into core PCE, that's the Fed's preferred inflation measure, those remain especially sticky. And we haven't even really seen the full impact of tariffs yet. So if we take a look at those December projections on your screen, core PCE was previously projected at 2.5%. For rate cuts, the Fed previously priced in 2 rate cuts to come this year. Markets are currently at around 3 due to some of those growth concerns. And then speaking of growth, GDP previously forecasted to hit 2.1% in 2025. Now, Goldman Sachs saying that FOMC participants, they're likely going to adjust to a bit more cautious tone until that tariff policy becomes more clear. They're expecting the median projections for core PCE to inch up to 2.8% and for GDP growth to slow to 1.8%, mainly reflecting the tariff news. So moral of the story here is that we have a lot of policy uncertainty, a lot of tariff uncertainty, and Jerome Powell, markets are looking towards him and the Fed to really guide us, to really help make sense of all of this. But that's a really tall order, especially since we've seen a pretty big sell-off over the past month.
As usual, I do not envy him his job.
Nope, not at
Thank
all.
you so much, Allie. Appreciate it. Well, let's talk more now on what to expect from the Fed moving forward, given all the economic data. Joining us now, Yelena Maleev, a KPMG senior economist. Good to see you, Yelena. So we were just talking about all of the data that we have gotten. Now, we were talking about hard versus soft data, what that's going to mean to the Fed. But today we did get some hard data in terms of retail sales that came in a little bit less than estimated. So how are you reading, I guess let's talk about the growth side of the equation first, and how you're reading that and how you think the Fed is going to assess it.
Definitely. So American consumers seem to be gripping their pots of gold tightly, unwilling to test their luck amid all of this economic uncertainty and cloudy outlook ahead. So we did see that actually core retail sales that feed directly into GDP did rise 1%. So that gives us about a 1% annualized growth rate for the first quarter for overall GDP, which is less than half of what we saw in the fourth quarter. So it is a real slowdown. The hard data is starting to show a real slowdown. Consumers have been showing souring sentiment for some time. We're at the lowest sentiment levels in 2.5 years, but now we're seeing that matched with a pullback, especially in discretionary spending, especially by those higher income households that have really been holding up the economy over the last few quarters.
So that doesn't sound great on the one hand. And then we have inflation on the other hand. What's your assessment of inflation, and how patient do you think the Fed is going to be able to be?
The Fed is going to have to be quite patient because they don't want to front run any policy on tariffs or supply chain disruptions. They have been more willing to wait and see the impacts of these disruptions in the past years. And so we do think that the Fed is going to be on hold for the remainder of this year, barring any sort of economic recession or sort of crisis that would cause them to have to cut this year. We do think that inflation is going to start to turn up, perhaps maybe nearing that 3%, maybe just a bit higher year on year into the second half of the year. And that would put the Fed in a very difficult position of not wanting to cut and creating that more inflationary environment, but of course being aware of the part of the stagflation and not wanting the economy to go into a recession if it doesn't have to. So a very tough line to balance for the next few Fed meetings for sure.
Yeah, that is. Yelena, the market's now pricing in, though, 3 rate cuts. But before it was 2 rate cuts. And I wonder, what do you think the Fed's going to watch most closely in terms of this alleged growth scare?
I think the Fed is still going to be watching their dashboard of data to understand really where the price pressures are coming from. So if we see more softening price pressures, so maybe not as much hoarding of inventories ahead of time, maybe not so much front-running tariffs, maybe some alleviation of tariff announcements, if you will, then I think the pathway for the Fed to cut will be a bit wider for this year. But of course, if we do see that hoarding behavior, those supply chain disruptions, additional supply side shocks that the Fed is just not equipped to deal with because they're a demand side toolkit. So we do still think that they have a hard road ahead. But if we do see significant deterioration in the labor market, if the labor numbers do start to tick up significantly higher than they have over the last few months, the Fed will probably have to start cutting earlier than next year compared to our baseline forecast.
Yelena, it's interesting to hear you say that there might not be a cut this year, because I want to play for you a response that we got from Stephen Junot, who's an economist over at Bank of America, what he told us earlier today about his outlook for cuts. So take a listen to that.
So we're out of consensus. We don't think the Fed's going to cut this year or next, really. We think that the Fed's juggling with this problem where even if you get weaker growth, well, you're likely going to see higher inflation. So they're balancing their dual mandate, and they're likely to lean on the fact that, hey, we haven't hit our inflation mandate. We're not comfortable unless we see growth really deteriorate to kind of move quickly and cut quickly. So for us, we think the Fed and the general economy will be supportive of current rates, and the Fed won't move.
Yelena, I thought this was a really interesting, I think this is the first person I've heard say, not only will there not be one this year, there might not be one next year either. How out of bounds do you think that is? Like, how likely do you think it could be that we might not even see a Fed rate cut next year?
So I do like to think about, Jerome Powell's recent comments where he invokes the spirit of Paul Volcker. The stagflationary economy of the 1970s that Paul Volcker finally broke the back of inflation in the 1980s had to do with hiking rates significantly to bring down inflation, even though we were getting a recessionary economy at that time. And so every central banker is aware of this cardinal sin of not wanting to cut rates too soon before inflation is down to the 2% target, because it has so much to do with Federal Reserve credibility and the credibility of the central bank to bring inflation down to the 2% target so that long-term inflation expectations remain anchored at 2%. And if the Fed is seen as cutting into an inflationary environment, that could potentially harm that credibility, those inflation expectations, which is what central bank participants in the last few months have been saying are what they're watching closely. If inflation expectations remain anchored, then of course they do think that there's some room to wait and see from the sidelines. But then if those things deteriorate, we could definitely be entering a stagflationary environment, which I can see them potentially not cutting into.
Wow. All right, Yelena, thank you so much for your perspective. I appreciate it.
Thank you.
Up next, some names in the restaurant space have been beaten down amid the worries over an economic slowdown. We've got to look at which ones you may want to consider in your portfolio. That's next. Now time for some of today's trending tickers. We start with Affirm, the buy now, pay later company. It hasn't been a good few days for the U.S.'s largest firm in that space. First, rival Klarna announced plans to file for its IPO on Friday. This morning, Walmart said that it was dropping Affirm in favor of Klarna for buy now, pay later purchases. Now, this basically the way that this is going to work is that if you use an app called OnePay to pay online at Walmart, the Klarna will be available through that. Affirm, by the way, did say in a statement that Walmart was only about 5% of its gross merchandise volume in the 6 months ended in December. So it is trying to downplay its exposure to some extent here, but Affirm shares are down pretty sharply here. And Barb, Klarna's going to come public soon. We've got this buy now, pay later space here. Is that a space that you're interested in investing in, that you're following?
Well, yeah, I think it's got some very interesting secular tailwinds, particularly if the economy is weakening. And if you look, it's very closely tied to consumer discretionary spending and e-commerce spending. And in that retail number this morning, which was up less than 1%, was like, 0.3, the e-commerce sales were actually up 2.3 or something like that. And so it shows you e-commerce strength is continuing. And that's why the buy now, pay later firms will do well. And Affirm had just reported a blowout quarter last month. I mean, it was firing on all cylinders. Margins are expected to be coming up, and they're going to be expanding their loan portfolio. So they've got a lot of growth ahead. So you've got secular tailwinds where the whole market size should continue to increase. And this one, it'll be interesting to see if this is the start of something, because they were gaining share against Klarna and other competitors. And so this may be a question where they just were not going to compete on price. Right. That the margins are going to be too thin. We don't know yet. So, I think it's still very interesting, and it may be a buying opportunity down here, but I want to hear more from management about this and what the actual, proposal was. Right. Because you wonder, is it the start of losing share or not? But It's been a fabulous company, and I think there's a lot of tailwinds to keep it going.
All right, we'll keep an eye on that, and of course, wait for that Klarna IPO as well. Our next trading ticker, a company called Insight. Shares are sinking as much as 10% today. That's after the drug maker released new data from a clinical trial. Joining us now, Yahoo Finance's Anjali Kamlani. And the data, it sounds like, was not as good as the last round trial of this same drug.
That's right, Julie. That's exactly why investors reacted the way they did. And we saw the stock drop as much as 15% earlier today. You can see it pared back just a little bit. So to recap what happened, the company had its phase 3 results for povorcitinib, which is an oral drug for a chronic inflammatory skin disease. And that drug had shown really positive results, able to reduce inflammation by 50 or more percent. So it did meet that end goal, but in not as many patients compared to placebo as in earlier trials. And so that's where you saw the drop off from investors. Now, taking a look at the sort of competitive space where there are some other drugs out there. There are also some traditional therapies, and that is an area that the company is focused on, saying that despite that lower number, it still offers value. And so it is going to continue, in light of the fact that it does have some efficacy, to continue forward with its filing with regulatory authorities to get approval. So despite the fact that the company didn't really wow Wall Street, it believes that it still has a valuable enough product to move ahead.
Anjali, thank you so much. Appreciate it. Well, retail sales for the month of February showing sales falling 1.5% for food, services, and drinking places. This comes as fast casual food stocks have fallen over the past month. We've got recession fears. We've got concerns over consumer spending worries. Joining us now, BofA Securities Senior Restaurant Analyst Sarah Senator. Good to see you, Sarah, as always here. So let's talk big picture first, right? And talk about all of these concerns that are swirling. We saw the numbers this morning in the retail sales report. What's your read on how fast casual, QSR, et cetera, is doing in this environment?
Yeah, well, thank you for having me. Nice to be here again. I will say that a lot of this was anticipated by, some of the commentary that the restaurants made on their fourth quarter earnings calls. So, most of them reported their fourth quarter well into February. So they had some line of sight to what was happening. And I think essentially what we saw is a big headwind from weather in the month. So, not just unseasonable cold weather, but really, road closures in parts of the Midwest and the South, restaurants that were closed. So that does put a damper. I mean, even on pizza restaurants, which typically benefit when people stay home, and some other restaurants that have like sort of a home meal replacement product, if the driver can't get to your house because the road's closed, that's not helpful. So I think, what we saw is really idiosyncratic in the sense of we had a little bit of a calendar shift. Valentine's Day fell on a Friday instead of a Wednesday. There were all kinds of things, less leap year. I mean, there were all kinds of things that played a role. And now as we're coming out into March, we're seeing a little bit more normalized demand.
So normalized demand, perhaps. What about on the cost side? What about on the tariff side? What about on the labor inflation side? What kind of trends are you seeing?
Yeah, so I think, having listened to a couple of your earlier, guests, I guess, I'm like Jerome Powell. I'm waiting and seeing, right? So we haven't actually had any impact from tariffs because, there's been so much back and forth. They haven't actually gone into effect. What we do know is most restaurants source domestically, but there's no question that if there are tariffs on our big agricultural trading partner like Mexico and other partners, there's going to be an impact. It's probably somewhere in the 100 basis point range, somewhere between 50 and 200. It depends on the sourcing. It depends on how much of the inputs. And of course, it depends on the knock-on effect. If there are tariffs on imports, then that means local production actually, it has to meet a much more robust demand and those prices go up. So for right now, the market labor market looks fairly stable, fairly much in equilibrium. Wage rates are going up 3-4%. That's pretty consistent with what we saw prior to COVID. Commodities are really wild card, beef in particular. So far, most restaurants are saying somewhere in that low single digit range for commodity inflation. But of course, things can change on a dime these days.
Yeah, Sarah, a question on the demand side. I mean, we're starting to hear, we've heard it for the last year, but it seems to be accelerating in terms of the pressure the lower income consumer is under. And you see McDonald's going to a more value-oriented menu. I mean, they also have had specific problems where maybe things got a little stale, but I wonder if you see in general, a trend going toward more value-oriented and trying to lower prices because they want to make sure demand keeps up.
Yeah, I mean, I think that's that's a very accurate assessment of what's happening right now. I mean, the lower income consumer has been under pressure. Frankly, we've been hearing about that even since I would say as far back as 2022, but really, in a more pronounced way in 2023. So, 2022, as the stimulus payments were rolling off, we were starting to see that. But now it does feel as if it has, if not accelerated, certainly it's not improved, even as we are lapping against a couple of years of soft demand by that lower income consumer. So, I don't think any restaurant has a choice but to offer very strong value. Can't only be value, but absolutely after a couple of years where restaurants took relatively high price increases because their own input costs were going up so much, we are certainly in an environment where you are seeing a little bit more of a shift to value. Again, it may even just be something as simple as underscoring value that's already on the menu, abundant value that's already there. Right. But certainly restaurants are at the very least talking about value more, and in many cases actually offering more value.
Sarah, I want to get specific with you, and I want to ask about Chipotle in particular. I know that you hosted them at a recent conference. I know you have a buy rating. The stock down 17% year to date alone, and there do seem to be some concerns here, maybe around that value proposition. I don't know. I'm curious to get your take here on whether it sounds like you think from the buy rating that people should be stepping in here.
Yeah, I think this is an opportunity. I mean, I'll say, first of all, most restaurants have been under pressure year to date because the consumer, certainly the consumer, the data have been cloudy. So, talked about calendar shifts. We talked about, weather. So it's been hard to know exactly what's happening. But it's also the case that, in a period of economic uncertainty, there is a sense among investors that maybe some of this more discretionary spending, which includes restaurants, might shrink. And I think what we're seeing right now is that is not the case. And Chipotle does have a very strong value proposition. So the pressure on the shares is sort of, fear about what might be. And again, we don't think it's the highest probability outcome as opposed to what's actually happening, which is the company is executing well.
Sarah, thanks so much. Good to see you.
Good to see you. Thank you.
Gold prices are hovering right around $3,000. That's a record. We've got the investor playbook, including whether you should consider the miners as well. We'll be back. Gold prices hovering around record highs with growing concerns about a slowing economy, maybe even a recession. Many investors are looking to gold as that traditional safe haven. We're navigating how to play the precious metal with the Yahoo Finance playbook. Joining us now, Chris Mancini, Associate Portfolio Manager of the Gabelli Gold Fund at Gabelli Funds. Thanks for being here, Chris.
Yeah, thanks.
And so in your world, you invest in gold through the gold miners. Correct. So talk to us about the value proposition of doing it that way versus gold itself and sort of how you think through which miners to look at.
Right. So what the gold miners give you is they give you income and they give you leverage to the price of gold. And they also give you growth. So what happens is a gold mining company, they generate revenue, they mine the gold, they have some costs, they generate free cash flow. With that free cash flow, they can either pay a dividend, buy back stock, or they can build another mine. So what you're getting with a gold mining company is gold, exposure to gold, plus that income and potentially the growth in the income.
Do you think gold is going to keep going up from here? And does gold have to keep going up in order for the prices of the miners to keep going up?
Well, that's a good question. I mean, I do think that the price of gold is going to keep going up. I mean, that's a big, long discussion about, big macro issues, but I do think that things by and large are unsettled now with the tariffs and the trade war. The economy, like you said, is slowing, so I think that we might have some more monetary easing from the Fed, which I think would be good for gold. But in terms of whether or not the gold price needs to go up for the miners to do well, I think that we're at a point right now where the miners have really underperformed the gold price over the past 5 years or so, and they're generating lots of free cash flow. So I think that even if the gold price stays here, the miners have a really good chance of having a good run.
Yeah, Chris, I have a question because it seems a little bit different this time why gold keeps making new highs. It was always a refuge in times of uncertainty, inflation fears, all this sort of thing. But it seems to be very different this time, that there's real demand from the central banks.
Right.
So you could talk a little bit about that because it seems to have started when we put the kibosh on Russia's central bank and people said, oh, treasuries may not be so safe after all. And is that what you're seeing?
Yes, exactly. So right after Russia invaded Ukraine, Russia had around $500 billion of U.S. treasuries and also euro-denominated bonds. And when Russia invaded Ukraine, the U.S. and the European countries like Germany and France said we're essentially, we're not going to pay you back at the end of the day. So we borrowed money, the United States and European countries borrowed money from Russia. Russia gave us the money, we gave them the treasury bills, and we said to them, we're not paying you back. So we essentially confiscated their dollar reserves. And so lots of other countries now who have these big dollar and euro denominated reserves, mostly dollar reserves, woke up at that moment, especially China, and said, well, wait a second, wait, you guys have the option not to pay us back? Like, that doesn't sound so good. And so they are selling some of their dollars, some of their U.S. Treasury, dollar-based treasuries, and buying gold. Because gold, they can't, it's in a vault, it can't be.
And is that a genie that can be put back in the bottle? In other words, there's now talk about potentially having some kind of ceasefire or peace agreement between Russia and Ukraine. If sanctions are lifted on Russia, does that change that calculus?
I guess it depends on what's part of the deal. So if, as part of the deal, we say to them, okay, we're going to give you your treasuries back, maybe it does change the dynamic a little bit. But I don't think, first of all, I think that that's unlikely. And second of all, even if it does happen, I think China's sufficiently scared, and I think that other countries are sufficiently scared to say it might be prudent to put some in gold instead of dollars.
Well, the implications for this are pretty serious, it sounds like, particularly since we have such big needs coming up. And also, how does it tie into, and this is outside immediate investment opportunity, but even to our being the world's reserve currency, how do you see this long-term, the possible impacts?
I think that there are significant impacts. I mean, I think right now, if you buy anything or sell anything, if you're a foreign country, not a U.S. country, it all settles in dollars, and that's because where the U.S. dollar is the reserve currency of choice, or I guess of default. And so when you start seeing these cracks in the system, and countries perhaps saying, I don't want to use dollars anymore because I don't trust it. I don't trust that I'm going to be able to hold these, that they might get confiscated from me. The tariffs, I think, also play into that in terms of, okay, this country's placing huge tariffs on us. Maybe we don't want this to be the currency that we need to hold. When those cracks start to enter, then you start to look for alternatives. And I think that the primary alternative to that would be gold. Because it doesn't have any of those issues of being able to be like needing to be paid back. Essentially, you own it, and it's again, all for thousands of years. It's why it's been the currency of choice. So I think that's why we're starting to kind of see that maybe like the path of least resistance is gold going up from here.
And how do you see the supply of gold?
Barb, we have to leave it here, actually.
Oh, darn.
Well,
This
we'll
is
have
so
you both back to
interesting.
continue this conversation. Chris, thank you so much for being here. Appreciate it. And Barb Doran, thank you so much for joining us for the hour. Really appreciate it. Well, wrapping up today's Market Domination. Don't go anywhere. We got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime. I wish we had a green room camera for you guys.